GM, good morning. Welcome to the Milk Road Show, the daily crypto show where markets are so dry, even tumbleweeds are holding cash on the sidelines. I'm your host, Jay Hamilton. It's Tuesday, it's Wednesday, April the 30th. Jeez, I'm slow this morning. We are live. What's up, everybody? We're on X, on YouTube. Great to see y'all. Today, we are very excited to be joined once again by Michael Howell, CEO of CrossBorder Capital, a global research firm focused on monitoring credit, liquidity, and capital flows in over 90 countries around the world. When Michael speaks, everybody listens, and for good reason, because Michael is able to explain what drives markets better than most. It's not what you read in the textbook. It's not what you're taught in school. It is changing because over the last 30 years, markets have been driven much differently than they have in the past as a result of accumulating debt. And we're going to explain all of that. We're also going to talk about the current liquidity situation. Where does Michael see tensions in the financial system? What's the impact of the trade war? What's going on over in China? Investors are de-risking in the US. What does that mean? And how does this all line up for your investment portfolio? And what is the outlook for gold and Bitcoin, both of which Michael is quite bullish on right now? Before we jump in here from Michael, if you guys want to hang out with myself and the Milk Road team every day, join us on our Telegram group. You can hit the link in the show notes and chat with us on a daily basis. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin, CSUSDL. Michael, welcome back to the Milk Road Show.
Jay, pleasure to be here. Looking forward to it.
Always a pleasure to have you. Thank you so much for your time today in advance. Let's start with, I want to start zoom out. I want to start with your overall liquidity framework. You've been doing a lot of thinking, especially this year, but over your entire career, about what moves markets. And recently you've been doing a lot of talking about what's the end game of this liquidity and debt cycle that we find ourselves in. Where does this all lead? Let's zoom out and start with, in your view, what is the most important factor in capital markets right now?
Well, I think without question, the most important factor is liquidity. And there's a whole host of reasons for that. But basically, it really comes down fundamentally to the fact that we're living in a debt-driven world where economic growth increasingly rests on increments of debt, fueling whether it be capital spending or more particularly consumer spending, but economies are being driven by debt more and more and more. There's less underlying productivity growth, as many of us are sort of realizing over time. And in a debt-driven world, the fact is that debt has to be refinanced. Debt is not there permanently. It has a term, and that term is probably on average about 5 to 6 years. And it's that 5 to 6 year maturity term which really governs what we think of as the global liquidity cycle. That cycle fluctuates with that frequency, which pretty much aligns with the average maturity of world debt. Now, if you are going to tell me that world debt is suddenly going to reverse in size, in other words, the pool of debt is going to shrink over the next 20 years, well, I'll come quietly and say, well, liquidity is going to disappear, and we ought to be dumping all these assets like Bitcoin and gold. I don't happen to believe that's true. I think the fact is that the pressures on mandatory fiscal spending, whether it be Medicare, Social Security, increased defense spending, or whatever, it's going to push up the federal deficit over the long term. It's going to increase the stock of debt, and that debt basically needs to be refinanced, and you need balance sheet capacity to do that. Balance sheet capacity is my definition of liquidity, or balance sheet capacity in the financial sector is a definition of liquidity. And therefore, that means that the debt liquidity ratio over time has got to remain stable for financial stability reasons. And therefore, as debt goes up, liquidity goes up. And if liquidity goes up, that's monetary inflation. And if you've got monetary inflation, you want monetary inflation hedges, of which gold and Bitcoin are pretty decent candidates. And that's really the essence of the view. So the real question is in an environment where you've got prospectively debt growth of something like maybe 7 to 8%, which is besting GDP growth by 2 or 3 percentage points a year, you've got debt growth of that magnitude, And that's kind of writ large in stone because of, as I say, mandatory spending commitments by the federal government in the US. But I mean, let's extend this globally. It's true worldwide as well. If you've got that situation, you're going to have similar rates of expansion of liquidity. So if you've got monetary inflation running at rates of 7 to 8% per annum, you've really got to ask, which assets shall I own, which are going to basically keep pace? And I think the short answer is the ones that have done well over the last 20 years. They're going to keep going. You don't want to get a lot of mileage out of fixed income markets unless yields suddenly spike higher to that sort of 7 to 8% level. But that would be disastrous for economic growth, and governments couldn't let that happen. So rule that one out. You don't want to be in bonds. You want to be in monetary inflation hedges. That means gold, that means Bitcoin, that means prime residential real estate, that means good quality equities. Those are the ones that typically perform. And, as I've long said, I mean, just take a very, very simple benchmark. From year 2000 to date, the stock of US federal government debt, marketable debt, has increased by almost tenfold. So, it's now circa 28 trillion, marketable debt, that is. Back in year 2000, it was about 2.8 trillion. So we've seen a huge increase. But over that time span, the value of gold has gone up by about 12 times. So gold has easily matched that expansion in debt, and Bitcoin's gone up even more, but clearly from a tiny base. But we know that historically, Bitcoin is a very good follower of the trending global liquidity.
Okay, so much to unpack and dive into there. And I want to chat about Bitcoin, but we'll get to that later in the show. First, I want to take a look at your outlook for the rest of 2025. It has been a tumultuous year for markets, and there is headline risk and geopolitical risk and macro risk that we have not seen in a while, which brings into question where things will lead, which I know is a difficult question to answer right now. But if you were to step back and give us an overview of what you are most paying attention to and what your outlook is for the rest of 2025, can you walk us through that?
Yeah, it's not inconceivable that the second quarter could see a continuing rebound of markets. That's possible because they basically got into a situation about a month ago when they were seriously oversold. I think that's fairly clear. So you would expect some reaction, some bounce, and that may continue. Liquidity conditions right now are not too bad. I fully accept that, although one's got to recognize that that's kind of coming through for technical reasons. US Fed liquidity has been quite buoyant of late, but that's largely because of the debt ceiling and the fact that the Fed has run down the Treasury General accounts. So there's been liquidity which has been pumped into markets temporarily to pay the government bill, when they couldn't use the fixed income markets to do that. So that's a fairly artificial and short-lived feature. However, you've got on the other side, which we can dig into later, China is actually opening the money taps pretty hard right now. There's a lot of liquidity being thrown at the system by China. And, it's our view that there's a deliberate devaluation of the Chinese yuan going on in the background. And that is being reflected in particular in the gold market, as we speak, or has been. So I think that there are sort of pros and cons about the liquidity outlook, over the short term, but probably, more positive short term than not. If you go beyond the second quarter and you start delving into third quarter, fourth quarter, I think there's much bigger problems afoot. And those problems really rest on two things. One is that the Federal Reserve itself seems very stubborn in terms of what it intends to do about its balance sheet. The Federal Reserve is still talking about shrinking its balance sheet further, which in my view is madness, because basically balance sheet policy or concern over the financial plumbing is now a really key element of central bank policy. It has to be. They've got to keep the system intact and keep it flowing. So that's something we learned very clearly after 2008. We learned it again in 2019 with the repo crisis. We learned it again in the 2020 COVID emergency. So, central banks have got to be there, and QE is an essential part of their toolkit. And we think we're running out of liquidity or prospectively in US money markets come the second half of the year, because the TGA, the Treasury General Account, will have to be, in all likelihood, rebuilt to its target levels, which probably sit something like 300 to 400 billion above where we are now. So that's clearly something to bear in mind. The other issue, which is looming, is the prospect of recession in the US, or more particularly, let's say, recession in the world economy, in which the US will also be a casualty. And that is something that ought not to be dismissed. It may not transpire that we actually get a recession, but we're certainly getting a very sharp slowdown in growth. And even if we avoid recession or skirt recession, the fact is that big growth slowdown is going to be something which affects the credit markets adversely. And already you're starting to see credit spreads blowing out. Now, the reason that this is an issue, and I can demonstrate with a slide that you can maybe slip up or put up, which is a slide which is a little bit further in the presentation, about number 7, I think I sent you, which looks at the structure of the world financial system. Now, this is getting a little bit in the weeds, I admit, but it may be illustrative or educational to look at this, to basically see how the world financial system has evolved in the last 20 years since the global financial crisis. And what it really says is, at the heart of the system, right in the center of that diagram, is a pool of collateral, and between the pool of collateral and global liquidity is the repo markets. And the repo markets are basically a form of lending, securitized lending, that is really the creator of most credit in the world economy. Something like 80% of all lending now is collateral based in some form, whether that's home mortgages in the traditional sense of backing a loan with real estate collateral, or whether it's a loan in financial markets where a hedge fund is doing a basis trade where they're posting collateral in the form of US Treasury bonds. Collateral is a critical element. Now, the point about that diagram is that, number one, the repo market is kind of the heart of the system, or the heartbeat of the system, and you need a functioning repo market. And as I've indicated, kind of just to the right of that, who oversees that is increasingly the Fed or central banks, operating as what you might say is dealer of the last resort. They've got to act in markets now, rather than going through the channels of normal discount window lending to regulated banks, high street banks. And the other point is that if you look at the collateral pool that is shown there, is the box in the middle of that diagram. The collateral pool traditionally has been very skewed towards public debt instruments like US Treasuries, which were always deemed pristine collateral. And they've started to shift increasingly into private debt instruments like collateralized loan obligations. And that's been done for reasons of regulatory arbitrage, because the bank or the treasury market or whatever has been more tightly regulated. And so you get the seepage outside of the system. And what that means is, quite in straightforward terms, is that the system is a lot more pro-cyclical now than it really ever has been. And so if you get a recession, private credit will sour. In other words, it will potentially default. The value will start to deteriorate. Market volatility may jump, which causes haircuts on a diminished pool of liquidity to shrink, or sorry, the haircuts to increase. So the effective collateral shrinks even faster. And so what you start to see is the collateral base of the system basically starting to tumble, and repo markets starting to feel a lot of tensions. Now, if you start to look at what is going on, and I think maybe the next slide may do that, or the next 2 slides will do that. What they show is, number one, this is an indication of bond market volatility. Now, that slide shows a lot of the elevation in volatility. So you can see from the chart that I've drawn, the normal zone is shown as that grey shaded area. And we've broken out of that very clearly. And we're now in a heightened period of volatility. And we're dancing around what I've illustrated there as the danger zone, when the system starts to break down when it gets significantly above about 150. Now, for ease of interpretation, you can treat that 150 as being basically 15% annualized volatility in the bond markets across the term structure, on an annual basis. Whereas the normal range is nearer, or normal level is normally about 7% or 70 on the index. So you can see we're at sort of double levels of volatility, which is unhelpful. And that will mean bigger collateral haircuts. The other problem, which is shown on the following slide, is that you're already starting to see tensions as a result in the repo markets. And this chart is monitoring the SOFR Fed funds spread, which is giving you an idea of growing tensions. Now, the point is that that spread should be within the trend lines, or somewhere near the lower trend line. It's basically been trading since the middle of last year towards the upper end of the trend line and has frequently breached that trend line, which is showing that you've got refinancing difficulties because SOFR rates, system overnight funding rate, is above Fed funds targets. And the SOFR rate is the key market rate in the system. So you can see there are problems emerging. And this looks to me like a trend. And therefore, the Fed has got to do something about it.
I want to continue down this conversation of the Fed and what we think they might do. But first, I just want to take a step back for a second, because I really want to make sure that everybody understands your view on how liquidity impacts financial crisis. And you wrote a post recently on your Substack. Everybody should go read it. We'll link to you in the show notes because it'll really help you understand this in great detail. But you quoted your argument here is the ultimate cause of all financial crisis always remains the lack of liquidity as compared to the tendency of modern credit systems to over accumulate debt. Crises are always and everywhere debt refinancing crises. In other words, they concern the inability to roll over huge piles of debt. And if I go to, let me find the slide here. This slide really explains this well. Can you walk us through this so we all understand this concept clearly?
Sure, Jay. Let me do that. And also say there is a Substack, another Substack, subsequent Substack, which is actually in front of the paywall, so it's free. It's a free view, which gives an outline of this whole global liquidity philosophy. And it goes into some of those things in a little bit more detail. But that's like a one-off to educate people that are interested in liquidity. This chart is basically saying it's measuring the debt liquidity ratio in the world economy. Now, what we're really arguing here is that basically debt needs to be refinanced. And if you're refinancing debt, you need liquidity, balance sheet capacity, in other words, in the financial sector to do it. And the debt liquidity ratio is really something you need to pay attention to. Now, for those that want to drill into this data, we do adjust the debt data for flow. So we're actually looking at the effective amount of debt that is being posted each year to be refinanced in this case. So in other words, it takes into account changing maturity. It's normalized for that. Now, if you get a very high debt liquidity ratio, such as occurred in 97, 98, or occurred during the time of the Lehman crisis or the Eurozone banking crisis, what you find is that you get refinancing tensions, and those refinancing tensions have their vent in the crises. So every one of those past crises that occurred, high levels of the debt liquidity ratio. So in other words, refinancing is difficult. So that tries to make the case that every financial crisis is a refinancing crisis. And then if you look at the other side of that dotted line, which is the mean value, what you find there is that you get asset bubbles when liquidity is way above required liquidity for debt rollovers. So a very low debt liquidity ratio means you get an asset bubble. And you can see where we've just come out of the cryptocurrency boom, or what you might call the everything bubble, where you had a very, very low ratio. And that low ratio was because, number one, central banks used liquidity as a policy tool, particularly after 2008 and certainly after COVID. They injected lots of liquidity. And the other factor was that zero interest rates, which were employed again through these crisis periods, encouraged many borrowers to term out their debt. So they pushed the debt, they refinanced the debt and termed it out to basically 5 to 6 years on. So we're talking about late 2025, 26, 27, maybe 28. that window is when a lot of this debt is going to come back into the system to need refinancing, and that will absorb liquidity. And that's the reason that line in the projection period starts to go from the bottom of the page to the middle of the page.
Okay, I want to jump to, let me find it quickly, the liquidity cycle and where we are right now. And then I want to talk about
The other way,
if this is it up, if the Fed is going to save us. I actually don't know if, there it is. There it is. So you've found that we follow this 65-month liquidity cycle. This has been backed up by external research as well from cycles.org. So it has been fairly proven that we are in this 65-month liquidity cycle and that markets move according to this liquidity cycle. Where are we right now in liquidity cycle? Is liquidity drying up? And then I think that'll naturally lead to this conversation of what is the Fed going to do, or are they handcuffed? What are their options, and how will they react?
Okay, well, the current reading is about 50 or thereabouts. There's been a lot of volatility over the last few months. That volatility is caused entirely by China. So if you took China out of the data, there'd be a much smoother incline in that line. The reason that China has been volatile is that they've been operating a stop-go policy in terms of their monetary accommodation. And that stop-go policy has really been dictated by strength or weakness in the Chinese yuan. So when the dollar was very strong in the fourth quarter, they had to take a lot of liquidity out of the system. Now the dollar has weakened, they can put a lot more back, and we can evidence a little bit later in the slide the amount of liquidity that China is injecting. What we've also done on that chart is to project forward that liquidity cycle. Now, there are two things to say about that. Number one is that our projections would suggest that it peaks at a lower level than the peak that we saw in 2021-22, okay, in the last cycle. And there are reasons for that, but the main reason is that the world economy in that period, in the COVID emergency, basically absolutely crashed, and central banks had to come in with alacrity and with size to actually inject a lot of liquidity back into the system. And a very, very slow economy basically doesn't need liquidity, so it throws it back to financial markets. So you kind of got a double whammy, lower demand for liquidity and a much increased supply, and that causes that liquidity cycle there to spike upwards. We factored in a recession in the world economy, a mild recession, I have to say. We factored in an assumption that says that oil prices, which are another drag on liquidity, basically drift up slightly. We've put in the fact that we also assume that you've got a slightly weaker dollar, but you've got to remember that the dollar is still fairly robust over a 2 or 3 year view. So, you know, we're not looking at a radically weak dollar in looking forward. And the other fact, which sort of impinges on this, is that bond volatility, or the value of collateral, which is another input in this system, is actually elevated, and doesn't seem like at the moment it's going to come down. So that's a negative. So you've got a number of positives and negatives. The main big positive is the People's Bank of China. The main big negative at the moment is the Federal, or the main big question mark is the Federal Reserve. But on paper, the Federal Reserve is slated to withdraw liquidity out of the system in the second half of the year. So that explains a lot of the gyrations that you're getting in that system. But, you know, basically, we originally envisioned that the cycle would peak in the second half of 2025. We think the peak may come a little bit later now, because there may well be easing by central banks over the rest of this year, or over the latter part of the year, you know, to try and revive stagnant or slowing economies. And that's maybe the change. Now, what do you want to do in terms of risk assets? Well, my view is that I wouldn't want to be too exposed to risk assets now, because there is so much uncertainty about the credit markets and about the state of the economy. And therefore, I prefer to keep my powder dry. But as soon as the central banks start to ease liquidity, what you should be doing is moving back again. And I think the long-term picture is crystal clear here, is that the only thing they can really or realistically do is to expand liquidity again to revive the system, which is monetary inflation, which basically lends itself to pushing up gold and Bitcoin in the medium term.
What would the Fed need to? I mean, one of the challenges, as you mentioned, is I wouldn't necessarily say unclear policy from the Fed, but as you said, right now their policy is saying no QE in the near term. So do you think they will change their policy, or what would they need to see in order to expand? Or do you think it's just inevitable and they're playing the political game and holding their cards close to their chest right now?
Well, I think if you look at, I mean, I'll say two things. I mean, there's a chart, I think about 3 or 4 slides on from that, which actually looks at the Fed balance sheet, or more strictly, the growth of Fed liquidity. Now, Fed liquidity was a concept that we came up with a few years ago, which is trying to look at the active parts of the Fed balance sheet. And this really comes back to a lot of the work that was done at Salomon Brothers back in the 80s and 90s on Fed watching. And it looks at the active parts of what the Fed balance sheet is really doing. So in other words, the balance sheet per se is not necessarily all liquidity creating. Only certain elements of it actually add liquidity to money markets. Some of them withdraw liquidity, such as the TGA will withdraw liquidity, the reverse repo account will withdraw liquidity if they're rising. And so we need to take that into account. So an expanding balance sheet isn't necessarily positive, or not always positive liquidity. What this shows is the active part of the balance sheet, the liquidity creating part. This is showing the growth rate. The volatility in that chart is in the projection period is all about the debt ceiling, the rundown, the rebuild of the TGA, the April 15th tax day, all these things come into it, additional seasonality in terms of spending by the federal government, etc. But it basically shows that, in the second half of this year, the Federal Reserve is slated on current policies and announcements to actually withdraw liquidity from the system. That doesn't look realistic. What I've shown in the little window there is a chart from the TBAC publication, the Treasury Borrowing Advisory Committee publication for Q4, which is basically illustrating what TBAC members are assuming happens to the Fed balance sheet over the medium term. And as you can see there, that looks remarkably different.
Very different.
Liquidity again. And that has to be the most realistic option out there. Now, I don't think this is really necessarily intended as a forecast, but it gives certainly a working assumption. That's what they're expecting will happen. That's what I expect to happen, but it's not happening yet. And it may be politics. I mean, why would Jay Powell now stand up and say he's going to expand liquidity?
Yeah. Yeah. It certainly feels very much like it's a Trump versus Powell battle that's happening right now behind the scenes. Let's talk about China. So, as you said, China is the biggest injector of liquidity right now. There's also, before we actually talk about liquidity in China, you mentioned at the beginning of the show that China has been purposely devaluing the yuan against real assets like gold. Do you believe that they are doing this on purpose? Can you explain this to us and what the implications are for the trade war right now?
Yeah. If you take a look a little bit later, there's a slide around slide 18. That one uses flip past.
There we go. Yep. Which
is looking at a rolling 6-month sum of liquidity injections into Chinese money markets. It's seasonally adjusted. The rolling sum is trying to smooth the data because it can be highly volatile. But it basically shows what the Chinese have been doing basically through the back end of 2024 when they took a lot of liquidity out, and more recently with them injecting liquidity back in again. Now, the sharpness of the policy change is probably evident from that. But if it's not evident, the following chart gives you a real, a clearer heads up to that. And what it basically shows is daily operations by the People's Bank. And I think you've got some indication of a change since the beginning of the year. This is daily data. And what it shows is a couple of big spikes, but the latest spike is happening around the end of April. I mean, this is latest data as of today. And what you can see is a lot of liquidity being thrown back at the system. Now, why is China doing this? It could easily be because the economy is skidding. I mean, the export numbers were clearly pretty terrible, the latest set of reports, and that's understandable. And the economy is clearly going to suffer in that regard, and China needs to offset that. But I think the other thing is shown by the following slide, which is looking at the debt liquidity ratio of China, and this is putting it into a longer term perspective. Now, the debt liquidity ratio of China, contrary to what you're seeing on average in the world, is actually elevated. In other words, there's too much debt relative to liquidity. The debt, we know the story full well, that China has taken on a huge amount of debt in terms of its economic growth in the last 2 decades. The liquidity story has really been impaired by the fact that the Chinese authorities have been withdrawing liquidity because of the weakness of the Chinese yuan, and they've been trying to maintain at least a stable yuan against the dollar, seemingly. Our view was that to get out of the debt problems that China had, they need to get that debt liquidity ratio at least back to an equilibrium level, the dotted line, which would require an expansion of liquidity of about 30%. So the entire Chinese liquidity stock has to go up by 30%. They're beginning that journey, or they're maybe well into that journey. The consequence of that has got to be a weaker currency in some form. But what we were trying to argue is, if you look at the following slide, what that illustrates is the yuan, the Chinese currency, the Chinese yuan, against the US dollar in black, and against the gold price in yuan terms in orange. Now, we think that what China really needs to do is not necessarily devalue the yuan against the US dollar, because it's obviously pretty competitive. That must be self-evident given the huge trade surplus. It wouldn't help if they weaken the yuan against the dollar, but they may need to weaken it against other currencies, and certainly they need to weaken it against real assets. Now, real assets are really the bane of the overvaluation of real assets. It's the bane of China, not least because debt is held against those real assets, and people fully realise that a lot of those real assets are worthless because of the debt burden they face. So what China needs to do is to devalue paper money against those real assets, and gold is a real asset, so gold may well be a decent benchmark of what is going on, maybe a lead indicator, but it shows what they're trying to do. Now, back in 2022, the beginning of 23, I think, in actual fact, the gold price in yuan was about 11,000 yuan per ounce of gold. It's currently around 25,000. So the yuan gold price has more than doubled over this period. And maybe China is doing this, through devaluation through a backdoor means via the gold market. But, it tells us something is going on. Now, the Shanghai Gold Exchange has really come from nowhere to be the dominant market worldwide. Since the 19th century, the London gold market has really been the main price setter, but that is no longer true. The Shanghai Exchange now trades at a consistent premium to London, showing there is an ongoing bid for gold from Asia. And that is likely to persist, in my view. But if you triangulate these two numbers and you say, well, okay, let's assume you stick at 7.3 yuan US dollar cross. And of course, by the way, there are capital controls, which mean that it's not really a true exchange rate. The cross rate's not really a true exchange rate. Very much managed. But let's assume it stays at 7.3, and you keep that 26,000 target for the gold price, which is what we envisioned originally. You get back to a level of US dollar gold of about 3,600, and we're not far away from that. In fact, we've almost tested that level. So, while I would suggest that gold is not going to keep its current pace up, on a day-to-day or week-to-week basis, I mean, clearly there'll be a pullback at some stage. The fact is that the trend is higher, And you've got to think about what China is doing and China's monetization process of actually driving that gold price upwards. Now, if the gold price goes up over the long term, Bitcoin's going to go up.
And that's exactly where I want to get into next, is your outlook for Bitcoin. Before we do, we just need to take a quick minute to hear from our sponsors who make this show possible. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, a trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and have never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn. Today's episode is also brought to you by Coinshift. Meet CSUSDL, the stablecoin built for institutions and DAOs. Don't just hold basic stablecoins, earn yield, all without compromising security. Backed by regulated real-world assets and secured with institutional-grade risk management by our friends at Stakehouse Financial, put your treasury cash to work to earning native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on-chain, including Aave, Gitcoin, and hundreds of leading institutions, CYCS USDL is gaining traction at milkroad.com/Coinshift. All right, we're back. Michael, let's shift to Bitcoin. What's your outlook on Bitcoin in this current market?
I think if you shift to the very last slide, that probably nails our view in terms of what's going on. And there's a pie chart there, which is basically a statistical analysis of what goes into driving Bitcoin. This is looking at the systematic influences on Bitcoin. It basically is, it derives from a vector autoregression model analysis of weekly data since 2015. It isolates systematic influences. It shows that global liquidity is the dominant slice of that pie. Clearly there are random elements which are coming on top, but these are the systematic influences. That would say that if liquidity is rising over the medium term, that's a key element. Then you've got investor risk appetite at just over 20%. Now, what that really is in straightforward terms is to say, well, that's something like, Bitcoin correlates with NASDAQ. So if risk appetite is moving upwards, Bitcoin's going to get a further impetus. If risk appetite is going down, as it has done markedly, since January 1 or certainly since middle of the first quarter, you get a big downdraft in NASDAQ and Bitcoin. So that's a negative influence. By the way, that risk appetite element does not feature in the influences on gold. So gold is a pure liquidity play. And then you've got two other elements at the bottom, which look a little bit complicated at first sight, which is the gold to Bitcoin ratio and the gold price itself. Now, why is there that sort of rather odd mixture of those two factors? Mathematically, those two slices make up what is called, mathematically at least, an error correction model. What that error correction system is defining in straightforward terms is the fact that Bitcoin and gold correlate positively and strongly over the long term, but they could negatively correlate in the short term. And that's exactly what's been going on lately. So if you look at what happened in Q4, Bitcoin was very strong, gold was weak. Q1, gold was very strong, Bitcoin was weak. And now you're seeing a reversal again. Bitcoin's catching up. So it's a little bit like, somebody, leading, having a dog on a leash, and the dog runs off and you race after it. And then you have to start pulling the dog when it decides it wants to go in another direction. And that's pretty much what happens. But in the long term, the owner and the pet move in the same direction. And that's pretty much what's going on there. So all those influences are going to tell me that, number one, if you think the risk appetite mean reverse, which it will do, that's clearly a tick over the medium term. If global liquidity is going up, which it is, that's a tick over the medium term. If you think the gold relationship is going to be positive long term, which I do, that's going up. And we know that gold is a very good monetary inflation hedge. And what's more, gold is being purchased by Asian central banks, People's Bank of China bought again last month, and this is a long-term trend. In the short term, what's going to happen to global liquidity? Well, it may muscle on a bit more in the short term, but we're near a peak. The gold market's run on a long way, but it could pull back, but that isn't necessarily a negative in the short term for Bitcoin. And risk appetite, well, who knows? A recession may force that down again. So you've got a choppy market. And as we say, we think that this is a trader's market, not really an investment market right now. But, if I look forward 12 months, I think you can definitely buy on weakness.
Would you expect to see Bitcoin back down in the 70s or at all-time highs first?
Well, I think the answer is I would doubt if you're going to get to all-time highs this run. I may be proved wrong, but I would doubt that. I think the risk of a pullback towards the 70,000s is real, but I think that's much more, I would venture a sort of mid-year, maybe Q3 event, depending on the depth of US recession, if it transpires. And we don't know. We've never been down this track before. The fact is that the tariff uncertainty is, it's certainly affected demand in China, but the real fact is it's affecting supply in the US economy. It's easier to change your demand backdrop than it is to change your supply, your suppliers. And that may mean that the US economy is disrupted, in a way that we can't really envision at the moment.
Michael, truly greatly appreciate your time and you breaking this all down for us. It's nice to get such a well-researched and well-thought-out approach to markets that is very insightful and different than most people who tell us to look at interest rates and think about it in the old ways. Thanks for joining us today, Michael.
Great pleasure. Thanks, Drew.
Thanks for listening in, everybody. Have yourselves a wicked awesome day. I need to remind you, nothing in today's show was financial advice. You should do your own research and invest with your own risk appetite. Remember that investing in Bitcoin, gold, or any asset is risky, and you should take on only the risk you are willing to take on. With that being said, we hope to see you guys back again tomorrow on the Milk Road Show. Thanks for tuning in, everybody. Have yourselves a wicked awesome day.